You are here because you are greedy, and while greed is a powerful motivator, it is also the architect of your inevitable destruction if you possess the intellect of a gnat and the temperament of a caffeinated toddler. You are looking for a map to the treasure, a secret formula that will turn your pitiful savings into a bonanza by next Tuesday. But I am here to tell you that the map you are holding is upside down and leads directly off a cliff. The most asinine delusion plaguing the modern financial mind is the belief that investing is a game of brilliance, a contest where the man with the highest IQ or the fastest computer wins the pot. This is total folly. It is a lie sold to you by investment bankers who want to sell you fees and by charlatans on television who want to sell you advertisements. As I stated clearly at the 1998 Berkshire Hathaway annual meeting, it is not brilliance that makes you rich. It is the avoidance of stupidity. You are trying to be smart, and that is your first mistake. If you want to survive in this game, you must learn that the path to heaven is not paved with genius, but with the systematic removal of the things that send you to hell. You are obsessed with winning, but you have no concept of how easy it is to lose, and that asymmetry is why you will fail. You look at the stock market like a casino where you are the house, but you are actually the drunk tourist at the blackjack table doubling down on a pair of fives. The great businesses of the past, Standard Oil, the early iterations of Carnegie Steel, and indeed the fortress we built at Berkshire Hathaway, were not constructed by people frantically checking stock prices or reading the tea leaves of technical analysis. They were built by men who understood that the first rule of compounding is to never interrupt it unnecessarily, and the second rule is to recognize that most opportunities are rat poison dressed up as chocolate cake. In the old world, a man like John D. Rockefeller didn't wake up asking, "How can I triple my money this week?" He woke up ensuring that his costs were lower than his competitors and that his position was unassailable. Contrast that with the modern fool, the day trading imbecile who treats the New York Stock Exchange like a video game, seeking the dopamine hit of action rather than the slow, boring accumulation of wealth. I have said this at the Daily Journal meetings for years. The big money is not in the buying and the selling, but in the waiting. It requires a temperament that most of you simply do not possess. You have an itch to do something, anything, because you equate activity with productivity. This is a fatal error. The most successful investors I have ever known spent 99% of their time reading and thinking and perhaps 1% of their time making a transaction. You, on the other hand, spend 99% of your transacting and 0% of your time thinking. You are drowning in data but starving for wisdom. You see a stock price drop by 10% and you panic, or you see it rise by 10% and you succumb to FOMO, fear of missing out, which is really just a fancy acronym for envy, the stupidest of the 7 deadly sins because it's the only one you don't have any fun doing. Let me tell you about a mistake I made, a personal failure that cost me a fortune, just so you understand that even I am not immune to the siren song of stupidity when discipline lapses. In the 1970s, I had the opportunity to buy a significant stake in a company that was a compounded compounder, a business with a moat so wide you could sail a battleship through it. It was trading at a price that was fair, perhaps slightly rich by the deep value standards I had learned from Ben Graham, but fair for the quality of the business. I didn't buy it. I sat on my hands. I wanted it cheaper. I wanted a bargain. I was being too clever by half, trying to squeeze the last nickel out of the transaction. That decision, that failure to pull the trigger on quality because of a minor valuation disagreement, cost me, and by extension, my partnership, roughly $4 billion in present day value. I missed the boat. I was right about the business, right about the management, but wrong about the price of entry. I was trying to be smart instead of simply not being an idiot. I should have realized that paying up for quality is rarely a mistake, whereas waiting for a diamond to be priced like a cubic zirconia is a fool's errand. That 4 billion lesson is burned into my psyche. It is a scar that reminds me that while patience is a virtue, paralysis in the face of a Lollapalooza opportunity is a sin. You think you can afford to make mistakes. I couldn't afford that one, and I was already rich. You have no margin for error, yet you act as if you have 9 lives. This brings us to the mental model that you must tattoo onto the inside of your eyelids if you wish to avoid dying poor inversion. The mathematician Carl Jacobi said, "Invert, always invert." He knew that many hard problems are best solved when they are addressed backward. If you want to help India, the question you should ask is not how can I help India, but rather what is doing the worst damage to India and how do I stop it? In investing, you do not ask, how do I make a 10 million? You ask, what are the specific behaviors that will cause me to lose everything I have? And then you avoid those behaviors like the plague. It is standard doctrine at Berkshire that we spend more time thinking about what can go wrong than what can go right. If you avoid the losses, the winners take care of themselves. It is simple algebra, yet you complicate it with your ego. You want to find the next Amazon, but you should be focusing on not buying the next Enron. The road to ruin is paved with people who were trying to get rich quick. The road to wealth is paved with people who were terrified of going broke. Let us apply this inversion to your pathetic strategy. How do you destroy your financial future? It is actually quite easy. Number one, use leverage. Borrow money to buy things that fluctuate in price. If you want to guarantee misery, trade on margin. I have seen more smart people ruined by leverage than by liquor or ladies, though those two are close seconds. Number two, follow the herd. If everyone at the cocktail party is talking about a stock, it is already too late. Avoid it. Number three, invest in things you do not understand. If you cannot explain the business model to a 12-year-old in 3 sentences, you have no business owning it. This is what I call the circle of competence. Inside that circle, you are safe. Outside of it, you are shark bait. Most of you have a circle of competence the size of a dime, yet you are betting on the global macro economy. It is insanity. I am not your advisor. But if I were, I would tell you to consider taking a piece of paper and writing down every foolish thing you could possibly do with your money. Day trading, buying crypto, chasing yield, trusting projections, and then simply don't do them. If you can just avoid the standard modalities of failure, you will drift into success. The modern financial ecosystem is designed to exploit your psychological weaknesses. It is a machine built to transfer wealth from the impatient to the patient. You are fighting against algorithms, high-frequency traders, and insiders, yet you walk onto the battlefield armed with a Robinhood account and a Reddit thread. It is a slaughter. You must understand that the market is a voting machine in the short run and a weighing machine in the long run, as Ben Graham taught us. But you are obsessed with the voting. You care about the popularity contest. You see a stock rising and you think the crowd must know something. The crowd knows nothing. The crowd is a manic, depressive lunatic. When you invert the problem, you realize that the only way to win is to detach yourself from the crowd. You must be willing to look like a fool in the short term to be a king in the long term. You must be willing to sit on your ass for 5 years doing absolutely nothing while your neighbors get rich on some speculative garbage, and then be ready to strike when that garbage collapses and the streets are running with blood. There are essentially 3 baskets for investing decisions: yes, no, and too hard. This is the embedded list of choices you have every time you look at a ticker symbol. Yes means you understand the business, the management is rational and honest, and the price is right. No means it fails one of those criteria. Too hard means you don't understand it, the accounting is suspect, or the future is too unpredictable. For 98% of the opportunities you see, the answer should be too hard. I have a pile on my desk labeled too hard, and it is the biggest pile I have. I simply move on. I don't agonize over it. I don't try to be brilliant. I just put it in the too hard pile and look for something easy. You, however, treat too hard as a challenge to your ego. You think you need to have an opinion on everything. You don't. You only need to be right a few times in your life to be fabulously wealthy, provided you don't blow it all up in between. The refusal to utilize the too hard pile is why you are mediocre. You are swinging at every pitch, including the ones in the dirt. Inversion also requires you to look at your own psychology with brutal honesty. What are your triggers? Do you get jealous? Do you get scared? Do you have an overwhelming need to be right? These are defects. They are cracks in your hull. If you do not patch them, the ocean of the market will find them and crush you. I have spent a lifetime trying to cultivate rationality, which is nothing more than the ability to see the world as it is, not as you wish it to be. Most of you view the world through a lens of wishful thinking. You buy a stock and then you only read the positive news articles about it. You ignore the warnings. This is confirmation bias, and it is lethal. Invert that behavior. When you buy a stock, you should aggressively seek out the arguments against it. You should try to destroy your own thesis. If you cannot find a smart person who disagrees with you, you are probably not looking hard enough, or you are the patsy at the table. The history of financial disaster is not a history of bad luck. It is a history of bad behavior. It is the history of people who forgot to invert. They asked, how high can this go? Instead of, how much can I lose? They asked, what if I'm right? Instead of, what if I'm wrong? You must develop the capacity to handle bad news, to handle volatility, and to handle the boredom of discipline. If you cannot do that, you should buy an index fund and go fishing. But you won't do that, will you? You want the glory. You want to be the hero. And that desire for glory is exactly why you will end up as a cautionary tale. I have watched people lose millions, brilliant people, people with high IQs, people with degrees from Harvard and Wharton, because they could not control their emotions and they refused to invert. They drove 100 miles per hour without checking if the bridge was out. Don't be like them. Be a survivor first and a winner second. Time is the acid that dissolves your delusions, and unlike your bank account, which can be replenished by a stroke of luck or a sudden inheritance, time is a non-renewable resource that is actively decaying every second you spend reading this. You treat time as if it were infinite, squandering it on trivialities and mediocre investments, acting as though you have 500 years to correct the compounding errors of your youth. You do not. You are biological machinery destined for obsolescence, and the mathematics of your remaining years is the most terrifying spreadsheet you will ever ignore. Every moment you hold $1 in a subpar investment, you are not just earning a lower return, you are actively burning the limited duration of your compounding runway. If you are 30 years old, you might have 50 years of investment runway left. If you are 60, you might have 20. The difference is logarithmic, not linear. When you waste a year in a stagnant asset, you are not merely pausing your wealth, you are amputating the final, most explosive years of your compounding curve. You are cutting off the tail of the distribution where the numbers become astronomical. It is an act of financial suicide committed in slow motion, and you do it because you lack the discipline to sit still and the courage to strike hard when the clock is actually in your favor. The fundamental algorithm of life, and certainly of investing, is opportunity cost. It is the only filter that matters. Everything you do is a trade off against everything else you could be doing. If you are holding a stock that yields 5% when you have a high conviction idea that could yield 15%, you are not playing it safe. You are losing 10% per year, compounded over a lifetime. That differential is the difference between owning the bank and cleaning the bank's floors. I have said repeatedly at the Wesco annual meetings that intelligent people make decisions based on opportunity cost, and idiots make decisions based on emotion or inertia. You hold on to losers because you don't want to realize the loss, or you hold on to mediocrity because you are too lazy to find excellence. This is insanity. Your portfolio should be a Darwinian arena where the weak are slaughtered immediately to make room for the strong. If a new idea is not better than your best existing idea, it should be rejected instantly. If it is better, then you must sell the inferior asset to buy the superior one. There is no third option. Yet you clutter your portfolio with 30 or 40 mediocre names, calling it diversification, when in reality it is diversification, a hedge against your own ignorance. This brings us to the concept of the fat pitch, a mental model I borrowed from the greatest hitter who ever lived, Ted Williams. In his book, The Science of Hitting, Williams carved the strike zone into 77 cells, each the size of a baseball. He knew that if he swung at a ball in his happy zone, he would bat 400. If he swung at a ball on the lower outside corner, still a strike, he would bat 230. In baseball, if you don't swing at a strike, the umpire calls you out. But here is the secret that the modern frenetic day trader fails to grasp. The stock market is a no-called strike game. You can stand at the plate, bat on your shoulder for 6 months, 2 years, 5 years. The market can throw General Motors at 40D and you can let it go. It can throw IBM at the 100 and you can let it go. You don't have to swing. There is no penalty for waiting. You can wait for the pitcher to lose his mind and throw you a fat, juicy meatball right down the middle, a wonderful business at a distressed price, and only then do you swing. And when you swing, you don't take a polite little chop at the ball. You swing with every ounce of capital you can scrape together. However, you do not have the temperament for this. You feel the need to be in the market at all times. You are terrified of cash drag, so you buy second-rate companies just to stay fully invested. This is the behavior of a gambling addict, not a capital allocator. The ability to do nothing is a superpower in a world addicted to stimulation. I have often said that it takes character to sit with all that cash and do nothing. I didn't get to where I am by going after mediocre opportunities. I got here by sitting on my ass. The big money is not in the buying and selling, but in the waiting. But waiting is hard. It requires a suppression of the ego. It requires you to watch your neighbor, who is likely an idiot, make money on some speculative garbage while you sit in cash. Can you handle that? Can you watch the fools celebrate while you wait for the inevitable correction? Most of you cannot, and that is why you are destined to be the liquidity that the patient investors consume. You are swinging at pitches in the dirt because you are afraid of striking out, looking unaware that in this game, swinging at bad pitches is the only way to truly lose. Let me illustrate this with a personal failure that still gnaws at me, a mistake of omission that cost me a fortune. It was 1977. The company was Belridge Oil. I knew the business. I understood the reserves. It was a simple enterprise sitting on a massive amount of oil in Bakersfield, California. The stock was trading at around 115 per share. Based on the engineering reports and the price of oil, I calculated the intrinsic value was vastly higher. It was a lollapalooza. It was a fat pitch hanging right over the center of the plate. I bought some shares for my family and a few clients. I bought 300 shares. It was a position, but it wasn't a commitment. I was being cute. I was trying to buy it a little cheaper. I was sucking my thumb. I had the cash. I had the conviction, but I didn't have the aggression to push all the chips into the center of the table. I acted like a man dipping his toe in the water when I should have been doing a cannonball. Then the inevitable happened. Shell Oil came along in 1979 and bought the entire company for roughly $300 to $700 per share. My 115 stock became $300 to $700 in 2 years. It was roughly a 30-bagger in a remarkably short period. I made money, yes, but I left hundreds of millions of dollars on the table because I failed to swing hard at a fat pitch. If I had bought 3,000 shares instead of 300, which I could have easily done, the difference in my net worth today would be staggering. The mistake was not in the analysis. The analysis was perfect. The mistake was in the execution. I allowed a psychological barrier, the desire for a slightly better price, to prevent me from seizing a bonanza. I was penny, wise and pound foolish. In the algebra of opportunity, I failed. I let a generational wealth event pass me by because I was too busy trying to be clever. You think losing money is painful. Try making a small fortune when you should have made a massive one. That pain lingers. It teaches you that when the odds are overwhelmingly in your favor, you must bet heavily. This failure reinforces the doctrine of the checklist. Did I understand the business?
Yes.
Was the management rational?
Yes.
Was the price attractive? Yes. Then why did I hesitate? Because of a defect in temperament. I see this same defect in you amplified 1,000 times. You see a great company, but you say, it's too expensive. So you buy a terrible company that is cheap. You are stepping over dollars to pick up dimes. You are ignoring the concept of quality because you are obsessed with the optics of value. In the long run, it is far better to buy a wonderful business at a fair price than a fair business at a wonderful price. Burridge was a wonderful business at a wonderful price, and I treated it like a casual fling instead of a marriage. Do not make this mistake. When the universe aligns to hand you a gift, do not ask for receipt. Take it, I am not your advisor. But if I were, I would tell you to look at your portfolio today and ask a brutal question. If I did not own this stock today, would I buy it at the current price? If the answer is no, you must sell it immediately. The mental energy you spend rationalizing a bad position is energy you are stealing from finding a great one. You are suffering from the endowment effect, valuing things simply because you own them. This is irrationality at its peak. You must view your capital as a mercenary army. It owes no loyalty to the terrain it currently occupies. Its only loyalty is to the highest rate of return. If you keep your soldiers in a swamp because you are fond of the mud, you deserve to lose the war. The algebra of opportunity also demands that you respect the rarity of great ideas. You act as if great investment opportunities are like buses. Another one will come along every 10 minutes. They are not. They are like comets. They appear rarely. When they do, they light up the sky. If you miss the comet because you were looking at your phone, you might not see another one for the rest of your life. Berkshire Hathaway has been built on perhaps a dozen truly great decisions over 50 years. A dozen. That's it. The rest was just avoiding stupidity and collecting dividends. You are trying to make a dozen decisions before lunch. You are hyperactive, and your hyperactivity is the friction that burns your capital. You need to slow down. You need to read more. You need to think more. And when you finally find that one idea that makes your blood run cold with its obviousness, you must act with a ferocity that scares your neighbors. You are likely sitting on a pile of cash right now, terrified of inflation, terrified of a crash, terrified of the unknown. Good. Fear is a better companion than hubris. But do not let fear paralyze you when the fat pitch arrives. The market will eventually crash. It always does. And when it does, the prices of wonderful businesses will drop to levels that make no sense. That is your moment. That is when you step out of the dugout. But if you have spent the last 10 years chasing Dogecoin or buying overpriced tech stocks because your brother-in-law told you to, you will have no capital left when the sale of the century begins. You will be a spectator at the banquet of the prudent. Opportunity cost is not just about what you buy. It is about having the powder dry to buy what matters. So invert your thinking on time. Stop viewing it as something you have plenty of. View it as a leaking bucket. Stop viewing cash as a wasted asset. View it as an option on future opportunities. And for the love of God, stop swinging at every pitch. Stand there and look stupid. Let the crowd laugh at your inactivity. And then, when the pitcher slips and hangs a curveball, knock it out of the park. Because if you don't, you will look back at your life with the same regret I feel when I think of Belridge Owl, the sickening realization that you saw the future. You held the winning ticket and you were too timid to cash it in. Don't be timid, be rational. And being rational means understanding that waiting is not a passive act, it is an aggressive strategy of ambush. You are drowning in a deluge of noise, a cacophony of yapping heads and self-appointed gurus who are desperate to sell you a map to a territory they have never visited. You sit in front of your television or your smartphone, absorbing the confident proclamations of people who possess what I call Shafir knowledge. I have told this story at the USC Law School commencement, and I will tell it again because you clearly didn't listen the first time Max Planck, the Nobel Prize winning physicist, toured Germany giving the same lecture on quantum mechanics over and over. His chauffeur, who had memorized the lecture by rote, said, "Professor Planck, it must be boring to give the same speech every time. Why don't I give the lecture in Munich, and you sit in the audience wearing my cap?" Planck agreed. The chauffeur delivered the lecture perfectly. He had the diction, the timing, the vocabulary. Then a physicist in the back stood up and asked a devastatingly complex question. The chauffeur didn't blink. He said, "I am surprised to hear such an elementary question in an advanced city like Munich. I will let my chauffeur answer it." The world is full of chauffeurs. They are the news anchors on financial television, the influencers on social media, and the analysts writing reports on Wall Street. They have the vocabulary. They can say UBITDA and quantitative easing and support levels with perfect pronunciation. They sound smart. They look the part, but they do not have the knowledge. They have memorized the script, but they cannot answer the hard questions because they haven't done the work. They are actors playing the role of investors. Listening to them is not just a waste of time, it is active self-destruction. You must understand that the financial media exists to sell advertisements, not to make you rich. They need to fill 24 hours of airtime every day. To do that, they must create drama where there is none. They must urge you to act when you should sit. They must pretend to know the future when the future is unknowable. If you base your financial decisions on the predictions of a man who screams at a camera for a living, you deserve the poverty that is coming for you. I ignore them all. I don't check the ticker. I don't watch the news. I read annual reports. I look at the facts. I stay within my circle of competence. This concept of the circle of competence is the moat that protects your castle. Yet you seem intent on lowering the drawbridge for every barbarian who passes by. You believe that because you are smart in one area, perhaps you are a good dentist or a competent engineer, that you are automatically smart in the complex adaptive system of the global market. This is hubris. Stupidity is not the lack of intelligence. It is the application of intelligence in an area where you have no experience. I have a very simple rule. I have 3 baskets: in, out, and too hard. If I cannot understand a business, its economics, and its competitive advantage with a high degree of certainty, it goes into the too hard pile. For me, high tech is usually too hard. Crypto is rat poison. Biotech is a casino. I stick to what I know. I stay inside the circle. You, however, wander out into the wilderness because you are afraid of missing out. You buy things you don't understand because a chauffeur told you to. You are playing a game against people who have devoted their lives to understanding a specific niche, and you think you can beat them with 15 minutes of research on Wikipedia. It is laughable. You must learn to say, "I don't know." It is a liberating phrase. It is the beginning of wisdom. When you admit you don't know, you stop betting on things you can't control. Confucius said that real knowledge is to know the extent of one's ignorance. Standard Oil was built by men who knew oil. They didn't try to build railroads. They bought the oil to put on the railroad. Stick to what you know. If you are a pharmacist, look at pharmaceutical companies. If you are a tech worker, look at software. Use your specialized knowledge as a lever. But do not assume that because you use an iPhone, you understand Apple's capital allocation strategy. Those are 2 very different things. The market punishes the pretenders. It strips them of their capital and hands it to the people who actually did the reading. If you are playing poker and you look around the table and can't figure out who the patsy is, it's you. In the stock market, the patsy is the person operating outside their circle of competence. Furthermore, you fail to understand the paramount importance of trust and character in this game. You think investing is about numbers. It is not. It is about people. If you get into business with a person of low character, No contract in the world will save you. I've never made a good deal with a bad person. Never. Yet you chase yields offered by shady management teams thinking you can outsmart them. You cannot. They will cheat you. They will dilute you. They will lie to you. When we look at a company at Berkshire, we look at the numbers last. We look at the people first. Are they rational? Are they honest? Do they treat the shareholders' money as their own? If the answer is no, we don't care if the stock is trading at 2 times earnings. We pass. We don't touch it. It is toxic waste. You need to purge your portfolio of toxic management just as you need to purge your life of toxic people. This brings us to the architecture of a good life, which is inextricably linked to the architecture of a good portfolio. You cannot be a disastrous person and a successful investor. Your character flaws will eventually manifest in your bank account. There are 3 decisions you must make, and you must adhere to them with religious fervor if you wish to escape the gravitational pull of mediocrity. First, you must live below your means. For if you spend everything you earn, you are a slave to the unexpected and have no capital to seize the fat pitch when it arrives. Second, you must never interrupt compounding unnecessarily, meaning you do not sell a great business just to buy a boat or pay a tax bill. You let the snowball roll until it is an avalanche. And third, you must remove toxic people from your life immediately and without apology because their irrationality is infectious and will cloud your judgment at the critical moment. If you can do these 3 things, you will win. If you cannot, you will lose. It is binary. There is no middle ground where you get to be undisciplined and wealthy. That world does not exist. Now, let us address the elephant in the room, your inability to accept that you have been wrong. You are holding on to bags of garbage because you don't want to admit you made a mistake. You are suffering from loss aversion. You think that if you don't sell, you haven't lost. This is a delusion. The market doesn't care about your cost basis. The stock doesn't know you own it. The money is gone. The only question that matters is this the best place for my capital right now? If the answer is no, you must cut the limb to save the body. I have taken losses. I have admitted mistakes. It is painful, but it is necessary. It cleans the slate. It frees up mental energy. You are carrying around the dead weight of your past decisions, and it is exhausting you. Drop it. Admit you were a fool. Sell the junk and move on. The tuition of the market is expensive, but it is only wasted if you don't learn the lesson